Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing XPEL stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.2 billion market cap. They're trading at $44 a share, and they have 27 million shares outstanding. XPEL sells, distributes, and installs protective films and coatings. The company offers automotive surface and paint protection film, headlight protection, and automotive and architectural window films, as well as proprietary DAP software. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. It's positive each year, so that's a good sign. You see, you don't need 10 billion of revenue to have positive free cash flow. They do it with under $500 million. Their highest free cash flow was in 2023, 30 million. It came down to 24 million in the trailing 12 months. Margins are in the mid to low single digit range, as low as 1% up to 8%. But as revenue grows, their margin should grow as well. Net income is the profit or loss on the income statement. It's revenue minus expenses. That grows nicely from 2021 to 2023, a slight pullback in the trailing 12 months to 48 million. Revenue is a sales for the company, and that grows every single year from 259 million to 400 million. So that's pretty impressive. $400 million. Could you imagine having a company with that much revenue? I had a math tutoring business for 10 years, and I never hit 1 million. I got close. I think around 900,000 was my best year. But besides the first year, it was a highly profitable business. We estimated 4 years of future free cash flows. We also estimated the terminal value of all cash flows past year 4, that's 1.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.3 billion. We divide that by 27 million shares. And we get a calculated stock price of $48. They're trading at $44, so they're trading at a 7% discount. It's a buy according to the model. What do you think? Do you think it's a buy or sell? Let me know in the comments. There are 48 companies in the same industry as XPEL, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only 8 million, a lot lower than median average. A good debt to equity ratio. For every dollar of equity, 20 cents of debt. It looks like they run a pretty efficient business. Positive free cash flow each year, positive net income each year, little debt. They generate 24 million of free cash flow. They rank 20th in market cap, 1.2 billion. They're trading at 7 times book value, 25 times earnings, 50 times free cash flow, and 3 times revenue. So their price multiples don't look so hot. They only generate 400 million of revenue. That's why their price of sales is so high. Garrett Motion generates 3.7 billion of revenue, but it's not that much bigger in market cap. It's only slightly bigger, like 30% higher, even though revenue is 9 times higher. XPEL has the highest 5-year annual revenue growth rate, 30%. Here's their latest income statement. Revenue up. It was 102 million last year, now it's 110 million. They have product revenue, 83 million, service revenue, 27 million. Service revenue is up more, but both are up. The direct expenses to generate the 83 million of revenue is 51 million. So those are pretty good margins, but look at the service revenue. Expenses under 11 million to generate 27 million of revenue. Really, really good margins there, which is what you would expect. Service revenue tends to have higher margins than product revenue. Gross profit, 48 million, up from 44 million. Operating expenses, 29 million. Operating income is down a little bit. It was 20 million, now it's 19 million. They spent 390 million of interest on their debt. It looks like they sell in other countries. A foreign currency exchange loss of 275 million. Net income, 15 million, a little lower than last year. EPS is 54 cents. They did add some shares, only 16,000 shares, so very little dilution there. So to summarize, I have them trading at a 7% discount. My target is 48. They're trading at 44. I rank them 7 out of 10, but 8 out of 10 if I would buy them. I really like the way this company manages their business. They don't use much debt, and their revenue and free cash flow are growing quite a bit. Free cash flow up 128% since 2021. Revenue up 54% since 2021. A nice steady growth. You don't need massive growth each year, but a nice steady growth year after year and managing expenses is the way to run a healthy business. Not everybody's going to be an Amazon and scale like crazy. Some companies are more modest and have a nice steady growth year after year. Their ratio is 3 out of 10. All their numbers are worse than the median. I give their financials 7 out of 10 because even with modest revenue, they're still generating positive free cash flow, and their revenue goes up each year. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.